Today we are going to be talking about the top 3 swing stocks for November 2019. But of course, the goal of these videos is to help you become a self-sufficient trader. So let's go ahead and start with how I find these opportunities. So for swing plays, we like more passive positions, and that means that we're looking for stocks that have gotten recently beaten down like a rabid dog and are now showing slow signs of recovering. Thing is that every reaction in the stock market is a dirty overreaction. Docu is a cookie cutter example of this. It got beat down twice on bad news. After just a small period, it had completely recovered. Another example of a similar situation was with Amazon a few weeks ago. It got beat down on negative guidance and then a full recovery. But this is just one side of the extreme when it comes to overreactions. There's also the other side. Pinterest, it got beat down like a rabid dog, which we love, and with Pinterest, the overreaction ended here. This is where the overreaction lows were, and it only recovered partially. The key difference with these is that while every reaction in the stock market is an overreaction, that does not mean that the whole reaction is unjustified. It just means that the reaction itself always starts with an overreaction. So it depends on the type of play, and that's why it's so important that you employ good trading tactics in order to take advantage of these opportunities. But of course, folks, we will go more into how to employ good trading tactics and strategies to take advantage of the opportunities that I'm about to present. But the only thing that I ask of you in return for this video is that you hit that ravishing like button. And of course, if this looks like an avocado, let me know in the comment section below. Okay, so before we start, a quick plug. We are about to end our first 400 promotion on ZipTrader U. Now, the goal of ZipTrader U is to help you expedite the growth of your account and become self-sufficient, starting from the bottom and building up, while also giving you the opportunity to have all of your questions answered and to work closer with me in our small private chat. Honestly, folks, as much as I'd love to say that I myself am a fast learner, it's just not true. The truth is I'm quite a hard head, and at the end of the day, it takes a while for me to actually get the information that's presented to me. So with that in mind, I created ZipTrader U to help folks who are in the same situation, folks that have a hard time connecting the dots, and of course combining everything together to help you get results. Anyways, with that being said, if you have any questions, feel free to direct message me or comment below. If you do decide to sign up soon, make sure to use that coupon code FIRST400 to get the discount. Okay, so let's go ahead and start with XPE. Now, XPE got beat down like a winter gnome in the summertime. This was on new information that Google was making changes to its algorithm that hurt their earnings and future expectations. Of course, this is a justified sell-off. It makes sense based on the news that came out. But since every reaction in the stock market is an overreaction, people overfreaked out, and it got beat down to $97.05 before starting to show signs of a recovery. We love seeing signs of a recovery. So now we are in the situation where we have a stock that has a massive amount of upward potential to even previous support. But when adjusting to its pre-reaction highs, there's an insane amount of upward potential for a fairly mainstream stock. When it comes to some of the more speculative plays that we have, there can be a lot of upward potential, but when you're looking at a penny stock or something that's just so sporadic, the upward potential doesn't mean as much. But when it comes to something like XPII, a very mainstream stock, all of a sudden this upward potential, if realized, means a lot. It's a lot more because it's a lot safer of a position as compared to something like Cara Therapeutics or one of the small therapeutic companies or biopharma stocks that we usually talk about. But we don't just take positions because something's been beat down. What is it exactly that we're looking for? Well, we want continued price strength. We love price strength. We don't just buy stocks because they've been beaten down, but rather because they've showed signs of recovering after they've been beat down. It's the analogy where you don't buy dead dogs on the side of the street. You wait to see if they're just sick and are showing signs of recovery. And we are starting to see this. It doesn't mean that it's going to continue like this, but we're starting to see some early warning signs. And this really shows that when it comes to swing trading, picking the right time frame is extremely important. It's of the utmost importance. Spotting a stock that has igniting price strength over our blue price strength SMA line is a huge start in identifying solid upward potential. But it's also important to be aware of deprecating factors. As traders, we're stacking, elevating, and deprecating factors and seeing where the probabilities lie. If the probabilities aren't in your favor, does it make sense to take a position? Well, it does if you want to burn cash. If you are in a correction position like this where we're thinking it's going to correct, that doesn't mean that it has to correct all the way. So you need to be ready to get out when your elevating factors turn into deprecating factors. For example, if you were to get in upon price strength and overselling, and then all of a sudden you have a validation point signaling loss of price strength and you are now overbought on the RSI, things have changed and it now makes sense for you to get out. And those are just two of the main elevating and deprecating factors that we need to keep track of as traders. And eventually these really get internalized, but those are just two big examples. Okay, next we have Med. Now Med got beat down on a negative earnings report. and poor guidance, and it was a top loser on Friday. Now, one of the things that I always say is that I love top losers. Top losers are fantastic. It's an overreaction 101. A top loser is something that's gotten beat down so much. There's nothing that could possibly go so wrong as to cause a immediate 25% reduction in share price. Sure, it could take a while and lose 25%, but if something goes down 25% so quickly, you know, hey, look, this is a massive overreaction. And this has proved to be true so far. It hit overreaction lows in the pre-market before showing price strength and running up. Now, the question is the overreaction correction done? Has it been completed? And this is what we're going to be analyzing this week. It hit overreaction lows in the pre-market on Friday before showing price strength and running up. This gives us a huge amount of upward potential and wiggle room for a partial correction, a partial continued correction. But let me be clear. Let me be perfectly clear. This stock isn't as enticing to me because it is already in a downward direction for most of its previous 180 days, and its downward direction below our red directional SMA line is a huge deprecating factor, and it's not one that I ever take lightly. If you have a stock that's routinely going downhill, just screams, hey, look, this is losing money, I don't want to get into a position that's consistently losing money. There's a difference between a quick discount and a long-term discount, and when you have both, such as in this situation, it doesn't necessarily help you become profitable because all of a sudden you're getting into a position that was already being discounted long-term, and it just sped up the process. So what all of this means in combination is that we need to be extra diligent in evaluating and looking for clear elevating factors, such as a strong price strength confirmation and making sure to get in at a good deal. What is a good deal? Well, we like to be below fair value or oversold, ideally as close to oversold or below the oversold line as possible. This is a very simple indicator that helps you figure that out. We love the RSI. Now, why is it that I spend time emphasizing this? This is trading 101. Well, the reason that I spend so much time emphasizing this is because a lot of people fail at trading specifically because they're overpaying for the opportunities that they're taking advantage of. I often go on a bunch of different trading forums, and one of the biggest pieces of advice is that you should be buying higher highs. It doesn't matter what a stock's doing, as long as it's breaking out past the previous high, you should always buy it. I've always hated that advice because it encourages folks to buy into overextended stocks. If you're focusing primarily on opportunities that are overpriced, you're going to be thrown in the dirt like a dog. That's just not how trading works. Imagine the logic of buying into something overvalued in literally any other market in the economy. If you're in a certain neighborhood and real estate is more expensive than ever, would you recommend folks buy it now, invest in it now because it's so expensive? Or even in the consumer segment, like if all of a sudden Apple decided to sell a $10,000 iPhone, would you recommend people buy it because it's so much more expensive now? The advice on blindly buying into higher highs makes absolutely no sense to me. So folks, you only should buy in when you have either a good deal or you have other strong elevating factors that outweigh the fact that you're overbought on the RSI. If at the end of the day, you don't have any elevating factors and you're not at a good deal, it just doesn't make sense for you to take a position. Just because something is more expensive does not mean that you should buy in. Okay, so ZG has actually been quite impressive for me. After a long sell-off, we've seen very consistent price strength, and as of Friday, it ran up massively. And this is sort of another example of a cookie cutter swing trade. We had a huge extended sell-off, and then all of a sudden we have opportunities to buy in upon price strength confirmation and simply ride the price strength up until validation. And this is ZipTrader 101. And this gets into the importance of choosing the right time chart. The wider the time frame, the more conservative you can be when analyzing swing trades. At the end of the day, folks, you need to pick the right time chart if you're trading off price action because you can have different confirmation points and different validation points and different indications on your indicators based on the time chart that you're looking at. And each time span represents a different level of aggressiveness or conservativeness and a different level of meaning because something that's oversold long term has a much different meaning as something that's just oversold intraday. But when we're getting into aggressiveness, the wider the time frame, the more conservative you can be when it comes to analyzing swing trades. But that also comes with a price, one of missing out on potential opportunities. If you're too conservative, you're going to miss out on some other opportunities that you would have caught if you were being more aggressive. And that's sort of the push-pull between being conservative and aggressive. It's really a gentle balance that takes practice and work to hone in on. Of course, shameless plug, we do cover time charts extensively in ZipTrader U, but you don't have to invest in education to understand that a confirmation of price strength long-term is more concrete. Long-term is more concrete than a confirmation of price strength in a shorter term time chart. Now we had ZG run up like an inflamed banshee, and since every reaction in the stock market is an overreaction, I'm not exactly sold on an entry point at this particular time frame. Stocks that get beat down massively have overreaction lows. It works the same way, just in reverse when it comes to overreactions upward. So what I'm going to be looking for is a small correction and then some continuation of price strength where we can find an opportunity to ride a potential wave back up further. By the way, for those of you who are having a hard time keeping up to date with all of these different picks and all of these different opportunities and news catalysts, I highly recommend that you get yourself in a good trading community. I recommend you join ZipTrader Circle, which is our free Facebook group where I post nightly watch lists, and we have tons and tons of traders who post and help people find the best opportunities. And it's of course free and in the description below, so please don't make excuses for why you're missing out on good opportunities. Okay, for folks who stayed until the very end of the video, I of course have a bonus. So, BA has been the gold standard of overreactions for the last 180 days. Literally buying in at any oversold point and selling out at overbought would have made a profit. This is our comeback king pattern. We love the comeback king pattern because that's a huge elevating factor if you can identify it. But the key with this is of course making sure to buy in when we are at the bottom of the interval. We want to ride the price strength, right? We want to ride the appreciation from oversold to overbought and make a profit that way while also combining our other elevating factors. So what we are looking for is another entry point below fair value and particularly close to oversold, if not oversold. BA is great because they have tons and tons of bad news releases, which causes overreactions quite frequently for us to trade off of. Anyways, folks, this concludes the video. I want to remind you to never be a slave to the market. So many people enslave themselves to the market. They look at the price action and they bow down. They bow down in submission. You cannot bow to the stock market. You need to show the stock market that you are the master. How do you show the stock market that you're the master? By having a concrete plan, making sure to only buy in when there's a confirmation of price strength and sell out at validation. But also making sure that when you're buying in at confirmation that you're confirming an already good setup. Look at your elevating factors. Are your probabilities in your favor? Are they not? Right? Decide that based on the different technical indications. But anyways, folks, I hope that you enjoyed this video and you saw some value in it. If you have any questions, feel free to reach out to us below in the comment section below or join our free ZipTrader Circle Facebook group. Of course, if you'd like to work closer with me in ZipTrader U, we also have ZipTrader U, and you can read more about it in the description below. Have a great day, and I'll see you in the next video.